It is now my pleasure to turn today's program over to Jennifer Brown. The floor is yours.
Great, thank you, and good afternoon. Thank you everyone for joining us today for our first official ULearn webinar of 2016. As always, our ULearn webinars are designed to provide you with the knowledge and insights that allow you to perform your job better. Real quick, I have some housekeeping items before I introduce our topic for today and our speaker. If you would like a copy of today's presentation, please reach out to myself or the MMA point of contact who invited you to attend. Also, today's session has been approved for HRCI and SHRM credits. We will be providing the appropriate program information at the end of today's call. Our topic for today is ACA tracking and reporting. Included will be an update on the recent deadline extension, as well as answers to commonly asked questions. Our speaker today is Stacey Barrow. Stacey is a partner with Morathis Barrow & Weatherhead and has over 15 years experience in benefits and group health practice. So without further delay and introduction, I would like to get our session started, and we'll turn everything over to Stacey. Stacey, you may begin.
Thanks, Jennifer, and good afternoon, everyone. It's Stacey Barrow here from Morathis Barrow & Weatherhead in Boston, and we are proud to partner with Marsh & McLennan Agency to offer today's webinar to their friends and clients. As Jennifer mentioned, today's topic is going to be dealing with ACA reporting. We have already gotten a number of questions that have come in, and we certainly encourage everyone to send in questions through the chat box. In light of the questions, I think I'm going to move a little bit quickly through some of the slides here, and I want to make sure that we have enough time at the end to answer everyone's questions. So I'm going to try to get through this in about 40-45 minutes or so. And so you may see me moving a little quickly through these slides in that endeavor. So I'm going to give a very brief review of the pay-or-play mandate. We'll talk about the two different types of reporting under the ACA. We'll get into the details on the actual forms, how to report for Cobra participants, some of the simplified reporting, and then we'll get into the questions. And I see there's a comment here about clicking on the phone line. Hopefully that is, hopefully that's not on my end. Okay, so jumping right into it, as you know, the pay-or-play mandate applies to what the government calls applicable large employers, and we're always looking back at the prior calendar year to see if we're going to be an applicable large employer in the current year. There are some delays and transition relief available for the pay-or-play mandate. Most mid-sized employers that are in that 50 to 99 full-time equivalent employee range, you don't have pay-or-play responsibilities until 2016, but the ACA reporting applies to all employers that have 50 or more full-time equivalents in the prior calendar year. So, you know, when we're thinking whether the reporting applies to us for the 2015 calendar year, we're looking back at 2014 to make that determination. There are two main penalty regimes under the pay-or-play mandate. There's the no-offer penalty. It's also known as the A penalty, the $2,000 penalty, or the nuclear penalty, to be even more descriptive, and that applies when the employers don't offer coverage to at least 95% of their full-time employees, and there was some transitional relief for 2015. And I'm going to move past this one, again, in the interest of time. The other penalty under the pay-or-play mandate is the $3,000 penalty, and this one is referred to as the B penalty or the unaffordable coverage penalty. And this one can apply when you have made an offer of coverage, but it is not, quote, affordable under the government's definition of affordable coverage. And so let's take a look at what they mean by affordable coverage here. Oops, I think I just skipped it. Affordable coverage means that the cost of single coverage, employee-only coverage, does not exceed 9.5% of the employee's household income, or these three safe harbors here. And I think you're all familiar with the safe harbors. One note here is that the IRS, right before the holiday break, released Notice 2015-87, confirming that employers can use the indexed amounts or indexed thresholds for 2015 and for 2016. So when you're trying to determine if coverage is affordable and you're looking to see, does the employee-only contribution exceed X% of W-2 wages, that number for 2015 is 9.56%, so that you get an extra 6/100ths of a point there, which might be useful if you were a couple of cents over the affordability threshold. As another reminder, the pay-or-play penalties, they do increase each year. They are increased for 2015, and they go up again for 2016. And you can see here they've gone up 4% per year, and so keep that in mind if you're trying to estimate any penalty exposure you might have. As another reminder, the Congressional Budget Office is expecting to take in about $50 billion in penalties under the employer mandate. This is obviously a major factor in how the ACA is going to be funded, and this is going to be even more important now given the Cadillac tax has been delayed 2 years until 2020. The government really will be looking for this revenue and will be seeking to enforce the pay-or-play mandate and the reporting. Oops. Okay, so now moving on to the bulk of today's presentation, ACA reporting. Part of what makes this reporting so tricky and complicated is that the Affordable Care Act added 2 new sections to the Internal Revenue Code, and one of them is reporting for providers of health insurance, and this is used to enforce the individual mandate. In this section, Section 6055, applies to insurance companies, and it also applies to employers that have self-insured plans, and it applies to most multi-employer plans and governmental plans as they tend to be self-insured. The other requirement is Section 6056, and this is employer reporting, and so this one applies regardless of whether you offer coverage or offer a fully insured plan or a self-insured plan. This reporting is simply used to enforce the pay-or-play mandate and to administer the premium tax credit program. And so here the government is interested in whether you've made an offer of coverage to your full-time employees, and if not, why. And we'll get into all of those safe harbor codes in a little bit. And then, of course, if you're a self-insured employer, you have obligations under both of these sections. One bit of good news here is the ACA reporting deadlines have been extended by about 60 days, essentially. So the old deadlines, we had to get these forms out to employees by essentially February 1st. We now have until the end of March. Likewise, the deadline to file the forms with the IRS, because they also get sent to the IRS, that has been extended from the end of February until the end of May if you're filing by paper, or extended from the end of March to the end of June if you're filing electronically. Electronic filing is required if you are producing 250 or more of any particular form. You're allowed to do it if you're a small employer, and there's plenty of small employers that are filing electronically. You can get a waiver from the electronic filing requirement if you file Form 8508. You can show reasonable cause there. A note about filing electronically, this is something we've heard from many employer clients out there. When it comes to registering yourself as an individual, a representative of your company, to file these forms and do all the reporting, the enrollment screen asks you a bunch of very personal questions, including your gross income from last year. And a lot of folks I know are very reluctant to give this information up, and they're saying, well, what does my gross income have to do with my company's ACA reporting? And the IRS is asking that question solely for purposes of identity verification. They're asking it because they have that information, and so they can check it, and really no one else should know that information but you. And so they're using it purely to verify your identity, and there's no way to get around it. There's no alternative You basically have to, provide your AGI from the prior year if you want to file electronically and be the representative from your company that's going to do that. If you were nervous about getting the forms in on time and you filed for a request for an extension for calendar year 2015 and you did that probably before the Christmas break, the IRS is not going to respond formally to any of those requests for extensions because these latest extensions here are more generous than the 1-month extension you would have received by the formal request for extension. So in future years, you can request a 1-month extension, but this year for the 2015 reporting, we have this 60-day delay here. Okay, so jumping in more into the nuts and bolts of the reporting, one thing that we need to cover here is how the reporting and how the penalties really apply. I think I probably skipped over it earlier, but when you're determining if you're a large employer, you're trying to figure out, do we have 50 or more full-time equivalents, you have to count your employees on a controlled group basis, meaning if you're part of a larger tax-controlled group, maybe you have a parent company, maybe you have subsidiaries, maybe your company is closely held by your owners and they own interests in other businesses, you'll need to aggregate all of those employees together to see if you're a large employer. And in fact, you're going to have to report that information on Form 1094-C. You're going to have to list the members of your controlled group, and so you need to understand whether you're part of a parent subsidiary controlled group or a brother-sister group, maybe an affiliated service group, and these are all legal determinations that should be made with the assistance of counsel. You might have already done this for your 401k plan, but if you haven't, we're happy to help with those analyses, and you can get in touch with us through your MMA point of contact. Now, once you've determined that you're a large employer and these rules apply to you, the employer mandate penalties in the reporting both apply on a per tax ID basis, meaning each company that has its own tax ID reports separately for its own employees. So, you have a parent and 5 subsidiaries. The parent in each of the 5 subsidiaries will complete their own 1094-C for their own employees. So in a way, this is kind of a good thing, makes it easier. You're only responsible for knowing about your own employees. You don't have to know what other members of your controlled group are doing, whether they're offering coverage, whether it's affordable, whether you're offering it to all employees or just some of them. It doesn't matter to you. You're only concentrating on your own employees. Here we have a quick reference chart, and that is just showing you the 3 different types of entities that can have an obligation here: an insurance company, an applicable large employer, or a non-applicable large employer. Insurance companies, for any fully insured plans, whether you're a large or small employer, the carrier is sending out the B series forms, 1094B and 1095B. So if you're a small employer and you're fully insured, then you have no filing obligation. The carrier is going to take care of it all on your behalf. If you're a small employer and you're self-insured, and we are starting to see more of these types of companies out there, then you have your own obligation to send out the 1095B form to your employees, and of course the corresponding 1094B goes to the IRS. If you're a large employer, you're always going to be completing the C series forms for your employees, for your full-time employees. If you cover folks that are not employees, and we'll talk about that in a little bit, then, for example, retirees, non-employee directors, Cobra participants in the year following retirement or following termination, and they're covered under a self-insured plan, then you can use the B forms for them. But in general, when you're a large employer and you're reporting on employees, you're sending out the 1095C forms with parts 1 and 2 completed if you're fully insured, and if you're self-insured, you'll complete Part 3 as well. And we'll get into what these forms look like in a couple of minutes. So looking now at Section 6055 reporting, and we're not going to spend a ton of time on this because, like it says here, if you're fully insured, you have no filing requirement under Section 6055. The insurance carrier is going to file it on your behalf. They're going to send the 1095B to your participating employees. They'll also send a copy to the service. And then 1094B is the transmittal form that's sent to the service, the IRS. Again, small employers, you're using the B forms if you're self-insured. In large employers, if you're self-insured, then you're using the C forms to fulfill your obligation under Section 6055. And you're also going to use those same C forms to complete your applicable large employer reporting. I know this gets kind of tricky, so we'll take a look at the forms in a second. As a reminder, you don't have to do reporting for HSAs, on-site medical clinics, wellness programs, self-insured dental or vision plans, any coverage that's supplemental to Medicare. And that's actually a clarification the IRS came out with somewhat recently, actually probably about a week ago. They updated their FAQ guidance to indicate that any coverage that is supplemental to Medicare shouldn't be reported. And so this seems to indicate that if you offer post-65 retiree medical coverage under a self-insured plan, you wouldn't have to report that self-insured coverage for employees who are also entitled to Medicare because Medicare is going to be primary. So helpful clarification there. Okay, and one more note here on the Section 6055 reporting is that the final instructions relieve us from some reporting with regard to HRAs, health reimbursement arrangements. Many employers offer an HRA in connection with a fully insured major medical plan, and the clarification here is that as long as the employee can only participate in the HRA when he is enrolled in your fully insured major medical plan, then the medical plan has the reporting obligation and you as an employer don't have to report that HRA coverage. An example of a time when you would have to report HRA coverage is when you offer an HRA to employees who are enrolled in another plan, like a spouse's plan. Then, because you're not the plan sponsor of both the medical plan and the HRA, you'll have your own reporting obligation for the HRA. But I think that's going to be rare, and so most employers out there won't have to be reporting on their HRAs that are integrated with that employer's major medical plan. Okay, so now we're getting into the meat of it, and this is the employer reporting. And again, we always are using the C series forms to be for retirees. I see a couple of questions coming on Medicare, and I will address those again at the end. This stuff has not been helped by the IRS, who have kind of the conflicting information in their regulations and then the instructions, and then they come out with clarifications there. And so I hate to contradict what I've said in prior webinars, but when they come out with clarifications, we do like to report on them. And it would have made sense if they had done this the whole time, but we have to take what we're given here. So I'll come back to the Medicare questions at the end. Okay. So here we get into the detail of Form 1094C. This is the transmittal form. You can think of this as essentially a cover page to a fax, where the body of the fax are all of the 1095Cs that you're going to send to the IRS. And so this is just a cover page to that, letting the IRS know, what are they getting here? How many 1095-Cs are they getting? What's the employer's name? Are they part of a controlled group? And that's where we start to get into some of these questions here. And the first question we always get is with regard to line 19, and I've drawn an arrow there, and they're asking the question, is this the authoritative transmittal for this ALE member? If yes, check the box and continue. If no, see the instructions. So the short answer here is that you're going to check this box, okay? Each entity with its own tax ID number is going to have one and only one authoritative 1094-C. So most companies, if you're only going to have one 1094-C for your tax ID number, then that one's going to be the authoritative transmittal, and basically almost everyone's going to check this box 19 here. So as I mentioned, there's no cross-reporting of related companies. You're only responsible for reporting on your employees. The next question we often get is line 21, and that is the ALE member a member of an aggregated ALE group, yes or no? And the answer here will depend on whether you're part of a tax-controlled group. Again, if you have a parent company, you are the parent company, you have brother-sister affiliates, those kinds of things, all legal determinations should be made with the assistance of counsel, but once you've determined that, you're going to answer yes or no based on whether you're part of a controlled group or not. Line 22 also is probably one of the lines we get the most questions on, and I want to spend a couple of minutes on that, and I'm going to get into more detail on subsequent slides as well. And so the question we always get here is, how many of these boxes do we check? All of them, none of them? Do we have to check them? What happens if we don't check them? And so these are all voluntary. You don't have to check these boxes. And in fact, A, B, and D are completely voluntary, and you can always complete your reporting without checking boxes A, B, or D. They're not necessary. They're not integral to your reporting. If you qualify to check those boxes and you want to check them and use the simplified reporting, it can ease some of your reporting obligations, and I'll get into that in a second. Box C, it is critical for some employers to check this box. And so I want to go on to the next slide, and we'll talk about this in some more detail. So when do you want to check box C in line 22? And that is when you need transition relief based on your size as a company. And there's two different types. There's relief for mid-sized employers that had 50 to 99 employees in 2014, and there's also relief for employers that had over 100 or 100 or more FTEs on average in 2014. The folks who it's critical to check this box is really the people in the 50 to 99 range. Meaning if you're not offering coverage in 2015 because you had that 50 to 99 FTE transition relief, then you want to make sure you check box C and you put an A in column E of Part 3 of Form 1094-C. And that's telling the IRS we're doing the reporting, but don't penalize us because we didn't offer coverage, because we have the mid-sized employer transition relief, okay? So critical for those 50 to 99 life groups that didn't offer coverage to all of their full-timers in 2015. The other group of employers that would be interested in checking box C here is when you are not offering coverage to at least 70% of your full-time employees until the start of your 2015 plan year. And so you need that 80 employee reduction from the $2,000 penalty. If you're not going to be subject to the $2,000 penalty because you've offered coverage to your full-time employees in 2015, you don't need to worry about checking box C then if you're a large employer. I'm going to move on from that one, but I'll come back at the end if there are questions. There are other types of transition relief. For example, you can avoid the $2,000 penalty if you've offered coverage to at least 70% of your full-time employees. That's a reduction from the 95% rule that's in effect for 2016. You can get relief if you don't offer coverage to dependent children yet, and then you can also get relief if you didn't offer coverage to at least 70% of your employees until the start of your 2015 plan year. And in these cases, the way you report this transition relief is you just put an X in the yes box in column A for lines 23 through 35 of Form 1094C. This doesn't involve checking any of the boxes on line 22. The other bit of transition relief that is important to understand how to report is relief for employers with non-calendar year plans. And so as you know, if you had, say, a July 1st plan year, it's very likely that you qualified for transition relief that would allow you to wait until July 1 of 2015 to offer affordable minimum value coverage to your full-time employees. And so the question is, well, how do we code those employees before the start of the 2015 plan year? Because we're going to indicate that we haven't offered them coverage yet. We're going to put down code 1H in line 14 until the start of the 2015 plan year if we really didn't make an offer of coverage to the employee, or if the offer was unaffordable and the employee didn't enroll. The way we're telling the government not to penalize us for that employee is we're putting code 2I in line 16 up until the start of the 2015 plan year. It's not code 1I that's different, that's not this type of relief. You want code 2I in line 16. So moving on now away from the 1094C, I want to talk about the 1095C, and this is the big one. This is the form that's going to go to all of your full-time employees. Anyone that was required to be treated as full-time during the year is going to get one of these forms. Part 1, I don't show. That's nothing too controversial there. It's simply the employer's name and the employee's name and other relevant information. Part 2 is where it starts to get a little tricky, and that is we have 3 lines here where we're reporting whether we've offered coverage, if so, what the cost of that coverage was, and then line 16 is what did the employee do with that coverage, and if he didn't enroll in it, is there a reason why we shouldn't be penalized if the employee were to get a subsidy? For example, was our coverage affordable under one of the safe harbors, and the employee's household income still put him in a position where he can get a subsidy, and so he got the subsidy, didn't enroll in the employer's plan, but we're going to report that we had offered him affordable coverage so that we don't get penalized due to the receipt of his subsidy. The IRS, in their inimitable fashion here, they're a bit funny. Line 16 is voluntary. The IRS has said you don't have to put anything in line 16 if you don't want to. It's completely voluntary. However, putting an entry in line 16, if you're able to, is the only way that the IRS knows that you shouldn't be penalized for the employee on whom you're reporting. So while you can leave line 16 blank, and you will leave line 16 blank certain times, depending on the facts, if you can put a safe harbor code in there, you should. And we're going to look at all those codes in a couple of minutes. Part 3 is only for self-insured employers. You're going to list the name of everyone who's covered under the plan, the employee, the spouse, and the dependent. That's the person who's listed in Part 1, themselves and their family members that are covered. You put in Part 3 here. You'll put their Social Security number in column B, or their birthday in column C if the social is not available, and then you'll just go and check their months of coverage that they had under the self-insured plan. One thing that I just want to be clear about, because I've noticed this in a couple of presentations or a couple of forms I've reviewed, is that the employers aren't putting the employee in Part 3. And you do need to do that. If the employee is enrolled in the self-insured plan, you're putting the employee and any other family members who are enrolled in Part 3. It's not just the spouse and dependents. And again, this only applies if you're self-insured. Sorry, my mouse is a little jumpy. It seems to skip a slide here and there. So now we're going to look at the line 14 codes for the offers of coverage. Code 1A is for a qualifying offer, and that's a loaded term. We're going to talk about exactly what that means in a minute, but one of the benefits of making a qualifying offer is when you have code 1A in line 14, lines 15 and 16 are blank. You don't need to worry about a safe harbor code. Whenever you have code 1A in line 14, you're going to leave lines 15 and 16 blank. Okay? 1B, C, D, and E are all relatively similar. It's basically saying that the employer is making an offer of coverage that provides minimum value either to the employee and the family members. And so 1B is employee only, 1C is employee plus children, 1D is employee plus spouse, and then 1E is full family coverage. And this is not specific to the employee, so if you offer full family coverage, you're just using code 1E. Even if you're reporting on a single employee, you don't get that granular and use 1B for someone that took single coverage. Again, if you have full family plan that you offer, you're using code 1E, or you can use 1A if you're making a qualifying offer. Code 1F is when you make an offer of coverage, but it doesn't provide minimum value. And so this might be one of those skinny plans that you heard about. They call them MEC plans, minimum essential coverage plans. And so those plans that don't provide minimum value are coded with 1F. 1G also causes a little bit of confusion. 1G is only going to be used by employers that have a self-insured plan and who offer coverage to folks that are not full-time employees. So as an example, if you have a self-insured medical plan and you offer coverage to pre-65 retirees, in the year following retirement, you have a choice. You can either give that retiree who's enrolled in your self-insured plan a 1095B form, or you can give him a 1095C form. If you give him one of the 1095Cs, then you'll put 1G in all 12 months in line 14, and then you'll just check the months of coverage in Part 3. I know it's a little odd, but we're basically telling the government, don't worry about this guy from a penalty standpoint. This is just someone that was not a full-time employee at any time during the year. He just enrolled in our self-insured coverage. Maybe he was a retiree, Cobra participant, non-employee director, partner, something like that. 1H is another frequently used code, and that is for no offer of coverage. If you've made an offer of coverage, but it's not good for every day of the calendar month, then you use 1H that month. So as an example, say you make employees eligible for coverage on date of hire. Anyone that's hired after the first of the month will have 1H in line 14 for their first month of employment, and the corresponding safe harbor code is 2D, as in dog, and I'll get into that one in a second. 1I will also cover in a couple of minutes, and that is qualifying offer method transition relief for 2015. This one requires that you have made a qualifying offer to at least 95% of full-time employees for 1 or more months of the year. So this one is going to be kind of rare. It is only going to apply if you're using code 1A and you're using that and making that offer to at least 95% of full-time employees in 1 or more months of the year. This gets really kind of tricky very quickly, and so I'm not going to spend too much time on that, but the slides cover them in detail. So if you have questions, you can look at the slides or type them into the chat box. Line 15 for the cost of coverage, we're only putting the cost of coverage in if we use code 1B, C, D, or E. Any other code in line 14 will not have a cost associated with it. And of course, the cost we're reporting here is the lowest cost plan that's available to the employee that costs minimum value, and the cost we're reporting is single coverage. So if the employee buys up the family coverage or he takes a more expensive plan, that amount in line 15 is not going to reflect what he's actually paying, and that's fine. Okay, these are the most important codes here, and that's the line 16 safe harbor codes. And so this is where we're telling the IRS why we shouldn't be penalized for the employee on whom we're reporting. Is it because he terminated? Okay, well, if he's not an employee that month, then we use 2A. If someone quits mid-year, obviously we're not going to be penalized for them after they quit, so we use 2A. 2B is generally used in the month of termination. If coverage doesn't extend until the end of the month and the employee terminates, we're going to use 1H in line 14 and 2B in line 16. It's also used if someone moves to part-time during the year. Once we're able to start coding him as part-time, we'll use code 2B. Code 2C is kind of the trump code. This is the one we use when the employee enrolls in coverage, and we use this one regardless of whether any other code applies, although there are a couple of exceptions. If he's a union employee, we'll get to union folks in a second. We're going to use 2E for most union employees, or if the employee has terminated and enrolled in Cobra, then we're still going to use code 2A, and we'll talk about Cobra again in a second. 2D is the limited non-assessment period, a very useful code. This is the code you're going to use when employees are in a waiting period or an initial measurement period. And so, you're not offering them coverage those months, and the reason is that, well, they're not yet required to be treated as full-time. They're in the waiting period, they're in the initial measurement period. 2E is for union employees, and I'll talk about that on the next slide or two. F, G, and H are the 3 affordability safe harbors, W-2, federal poverty level, and rate of pay. I think you're all pretty familiar with those. And then 2I is non-calendar plan year transition relief. And again, you're using that one if you qualify for it and you haven't offered affordable minimum value coverage to your employee until the start of the 2015 plan year, and you don't want to get penalized for the months prior to the start of that plan year, you would put 2I there if the employee was not enrolled in coverage. Okay, so let's talk about Cobra now. And again, the IRS went back and forth on this several times. And so if you think you're hearing inconsistent information or you're hearing information from different sources, it's probably not their fault. It depends on the day that you ask them because the service is all over the place on this. So final instructions clarify the reporting for Cobra folks. And they make a distinction here Cobra for terminated employees versus Cobra due to a reduction in hours. So most Cobra situations are going to be terminations generally, right? And so when Cobra is offered due to a termination of employment, we're treating that as no offer, 1H in line 14, and we're going to use 2A in line 16, regardless of whether the employee takes Cobra or not, okay? So the short of it is you kind of don't really need to worry about your Cobra folks, whether they've enrolled or not, at least for purposes of Part 2, because we're not treating that as an offer of coverage. Of course, if you're self-insured, then you're going to need to report enrollment in Cobra in Part 3. And then separately from the terminated employees, we have Cobra due to a reduction in hours. And here, that is the an offer of Cobra due to reduction in hours is treated as an offer of coverage. So you're going to use the same code that you'd use for any other active employee, like 1E. Line 15 will be the cost of Cobra coverage for a single individual. And then line 16, if he takes Cobra, it'll be 2C. And if he doesn't, line 16 is either going to be blank or any other safe harbor code that might apply could be used, like once the employee is able to be treated as part-time based on the measurement stability periods, then you'd use code 2B as a safe harbor. Okay? Union employees, there's a very simple method of reporting as long as you qualify for it, and that's using code 1H in line 14 and 2E in line 16. You have to qualify for this, though. So you have to be required to be contributing to a multi-employer plan pursuant to a collective bargaining agreement, and the plan has to be affordable, provide minimum value, and provide coverage to dependents. Now, most union plans are affordable and minimum value. You need to do your homework and just check and make sure, but the vast majority of employers with union employees are simply going to code them as 1H and 2E and be done with it. And the employees, the union employees will get their own 1095B forms from the union plan. So this is the qualifying offer. I'm going to kind of move very, very quickly through these last set of slides so we have time for questions. If you want to avail yourself of simplified reporting, take a very close look at these slides and make sure you qualify. So in order to have made a qualifying offer, the coverage must be affordable under the federal poverty level safe harbor. You can't use the W-2 or the rate of pay for this one. Basically, the cost of single coverage can't exceed about $93 per month. And if you've made that qualifying offer, it includes an offer of coverage to the spouse and children that they can buy up for, then you have the simplified reporting, and you can use code 1A in line 14. And again, the best part of this qualifying offer is when you use code 1A in line 14, then lines 15 and 16 are blank. Qualifying offer method transition relief, I don't want to get into the weeds here on it. Most folks are not going to be using it, and let me just move past it, and if we have questions on it, I'll take it at the end. One of the more useless aspects of the reporting, if an employer doesn't want to give a 1095-C to employees and they're not self-insured, then you can make an alternative statement rather than giving the form 1095-C to the employee. But this is, has limited usefulness because you still have to give a copy of that form to the IRS. So I'm not going to spend any more time on the alternative statements, what they look like, transition relief, nonsense. It's not going to apply to most people. 98% offer method will be useful to some employers, generally those that are self-insured and offer coverage to full-time and part-time employees. And I want to make sure we have time for questions, so I'm just going to go ahead and move past this one. One last note before we open it up to questions, and that is regarding penalty relief for this first year here. As long as you're making a reasonable good faith effort to get the right codes in and you file the reports in a timely manner, then the IRS is not going to assess penalties simply due to little hiccups in the codes, as long as you're reporting in good faith. The reporting penalties for failures have already increased. They've gone up to $260 per return. For 2015, the $3 million cap has gone up to $3 million and change, and the penalty for willful failures is $520 per return. And since one return goes to the employee and one goes to the IRS, you could have two failures there, so it could be a $1,040 penalty for a willful failure to send a 1095-C. We have some common questions and answers here. I would imagine they're probably all addressed in the Q&As, so I'm going to move past these and we'll just concentrate on the Q&As. Here's your HRCI and SHRM credits, and I'm going to leave this up here while I answer the questions. So we do have about 75 questions here. I'm going to do my best to get through them all before the top of the hour. First question is regarding code 1A in line 14. They're asking the employee has waived coverage, so what do we put in line 16? And again, anytime you have 1A in line 14, lines 15 and 16 are blank. Next question is, how do we handle Cobra for reporting purposes? I believe I've answered that, and I've addressed that in the slides, and there's a slide dedicated to it, so I'm going to move on to the next question. Similar question, what if we're not subject to Cobra as a church plan, but we offer continuation coverage anyway? I would treat that, once the employee terminates, I would treat it just like you would for Cobra, code 1H in line 14, code 2A in line 16, and then months of Cobra coverage along with the active coverage is going to be reported in part 3 of 1095-C. Next question is, I think this got cut off. Let me go on to the next one. I'm not sure what that question means. What if we issued a W-2, but the parent company offers and pays for insurance? We don't offer coverage, just the parent company, and that's okay. The offer made by the parent company is considered to be an offer made by you, by the entity issuing the W-2. So you just treat that just like you would offer the coverage, whether it's fully insured or self-insured. Next question is, if we have a fully insured plan with an HRA, do you report in Part 3? And the answer is no. You don't report the HRA because that reporting is handled under the fully insured plan, as long as the folks who have the HRA are able to be covered under the HRA are also enrolled in the group health plan. Next one is, we are permitted to use the 1095-C for Cobra participants? Yes. For the year after termination, if they're enrolled in a self-insured plan, then you may use a 1095-C for them if you'd like, and you would use code 1G in line 14. On the 1094-C and 1095-C forms, are both required to be filed with the IRS or just the 1094-C? Yes, both of them are sent to the IRS, the 1094-C and the 1095-C. We keep on hearing different reporting for post-65 retirees. If Medicare is primary, we do not have to report on them. Yes, and You are probably hearing different things on the post-65 retirees. This was just clarified, hopefully for the final time, just last week, and that is if Medicare is supplemental to the other coverage, or sorry, if the other coverage is supplemental to Medicare, you don't have to report on it. So it does appear that when you have employees who are covered under a self-insured plan and Medicare is primary, or sorry, I should say post-65 retirees, covered under a self-insured plan and Medicare is primary, then you shouldn't need to report on them. Next one is, have you heard of needing to report on pre-tax hospital indemnity under AFLAC? I was told we do. Where would this go on the forms? No. The hospital indemnity coverage is typically HIPAA accepted, and so it's not minimum essential coverage. It's kind of like dental and vision in that regard, and so it is not reported. What you are reporting, though, for pre-tax hospital indemnity coverage is if you have the W-2 informational reporting requirement and you've distributed 250 or more W-2s in the prior year, then you do add the value of that hospital indemnity coverage when employees contribute pre-tax, and that's in box 12, code DD of form W-2. If we only have 5 employees, do we need to do any reporting? No, as long as it's not a self-insured plan. And then the follow-up question to that from the same person is, what if a policy is a group policy that includes different companies? Some have more than 50 and some have less. That doesn't matter. What matters is whether you're part of a larger tax-controlled group. So if the group policy that covers those different companies, if they're all related to each other, if they all have the same parent company, then even the 5 life groups still have to report. You're what they call an applicable large employer member. Okay, this question I think got cut off earlier. This is company with union and non-union employees. The non-union folks are offered coverage through Blue Cross. Union employees on the multi-employer plan. When completing 1094C Part 2, Box 22, what do we check there? I do have slides on that. To answer your question, the union folks are not going to impact what boxes, if any, you check on in line 22. That's going to be determined by other factors. You'll see those on the slides, but they have nothing to do with whether you have a multi-employer plan or not. Okay, I think I answered that one. What are common reporting codes on line 14 and 16 for a self-insured plan issuing a 1095C for terminated employees actively on Cobra coverage for various months in 2015? So this is simple. You can see this on the slide. They're getting 1H in line 14 and 2A in line 16 once they terminate employment, the months following termination. Here's an interesting question. What if an employee waives insurance and is given HRA funds? How do you report this on the 1095? So you do then have to report it. You would report it, line 14 is an offer of coverage. The HRA would obviously cost nothing to the employee to see if he's enrolled, and then you'll list the participants in Part 3. Now, there's a compliance issue there that if the employee does not have other group health plan coverage, you cannot give him an HRA. So I think you should talk to your MMA point of contact there and maybe get some clarification there. We have several EINs that are part of a controlled group. Do we have to file a 1094-C for each EIN or only one? And yes, you must file a 1094-C for each of those EINs that have at least one full-time employee. If there's a pass-through entity that has no employees, then they don't report. They don't put together a 1094-C. I went over the union folks. Filing a 1095-C rather than a 1095-B for Cobra participants sounds voluntary. What is the advantage to filing a C if you're already filing the B? I think it's the other way around. You're filing the C forms. You're allowed to switch to the B forms in the year following termination when they have Cobra under a self-insured plan. The advantage to using the B form is that there's no code to worry about. You just check the months of coverage, and that's it, and you don't need to get into any questions with the codes. Next question is, what's the difference between Code 1A and 1E? They seem to say the same thing. They are similar, but the difference with Code 1A is Code 1A is representing that coverage is affordable under the federal poverty level safe harbor. Code 1E is just saying we make an offer of coverage to the employee, spouse, and dependents, but there's no representation there that the coverage is affordable or that it's affordable under the federal poverty level safe harbor, which is what has to happen for Code 1E. Is a good question. What if we hire an employee who's full-time and there's a 90-day waiting period? What do we put in code, or what do we put in line 14 for the first 90 days? So you're going to put 1H to show there's been no offer of coverage, but then in line 16, you're also going to put 2D as in dog for to show the waiting period. That's part of the limited non-assessment period. So obviously you're not going to get penalized for those first 90 days. Here's another good one. There's been some discussion among you experts about who to list in Part 3. The instructions say list covered individuals. However, other instructions say household members. Which do we list? You list the employee and any family members who have coverage under the self-insured plan for 1 or more days of the year. If someone has coverage for 1 day in June, then they're going to be listed in Part 3, and you're going to check June for having coverage. So it's the employee, and if this whole family is enrolled, the employee and the spouse and the children all listed as covered individuals, and then their months of coverage will also be listed. And they're not always going to match, right? I mean, people get married mid-year, you have a kid mid-year, the kid ages off the plan mid-year, and so there's going to be differences even among family members in Part 3. If we use Code 1G in line 14, are we required to complete lines 15 and 16? No. Code 1G in line 14 will result in lines 15 and 16 being blank. Have time for maybe one more question or two. How is 1E different from 1I in line 14? The difference is that line 1 or Code 1I you can only use if you've made a qualifying offer to at least 95% of full-time employees for 1 or more months of the year. So the slide you're looking at with the description of 1I assumes that you qualify to use 1I. So if you page through a couple of more slides and you look at the slide on qualifying offer method transition relief for 2015, then you'll see how to qualify for it. Most companies are not going to be using 1I. They're going to be using 1E. Let's see. We have a ton of questions left, and we're at the top of the hour, and I want to be respectful of everybody's time here, and I actually have to jump myself. If you still have questions out there, send them in to your MMA point of contact. We'll do our best to get them answered. I want to thank everybody for joining today. Good luck with the reporting. Do your best this year. Get them in timely, and you should be in good shape. And if there are further questions, just let MMA know, and we're happy to help.
Thank you again for joining us today. Please be informed that if you wish to access the PowerPoint slides, you will need to get in touch with the presenter to do so. This concludes today's web conference. You may now disconnect.